Mir, you want to come on railway stocks, Vande Bharat, markets?
Or Shatabdi.
Take your pick.
You are the fund managers. You guys have picks.
So, so the point is that the fact is that railway capex has gone up from 80,000 crores a year a few years back, 3-4 years back, to 250,000 crores. So that's a hard fact. And when you have significant increase in allocations, obviously companies are going to benefit from it, both the public sector as well as the private sector. So railways, defense, roads, I think these are trends and these are areas in which the government has demonstrated significant commitment to privatization as well as to spending more capex as much as it can. And there are hard numbers to back these finances. So I don't think the theme changes or the trend changes. And this railway and defense have come after a long time as a area. And when you have something which is at the beginning of a multi-year growth phase, I think there can be pockets of overvaluation, there can be some corrections, but that I don't think will take away from the overall theme of these segments, which is government capex in these segments like road, railways, and defense.
Road, railways, defense, all three. What do you like? What do you own?
Sorry,
No, what do you like within this government theme? Roads, railways, or defense?
So, see, in railways, the stocks are quite small and not very well covered both by the buy side or sell side. So our exposure is mainly to the capex theme in the public sector, which is the road builders, the construction companies, as well as some of the infra segments. And we have a significant exposure in the defense space.
Okay, so a significant exposure when it comes to the defense space, but the new kid on the block today was Mankind Pharma as well. I know, Mihir, it will be too early to probably take a recommendation as far as the Mankind Pharma is concerned, but the overall pharma space?
Pharma, we tend to look at it more on a case-by-case basis because every company has various mixes of branded, unbranded, generic, exposure to generics, branded generics, etc. So we really look at it on a case-by-case basis, stock-by-stock basis. But in general, over the last few years, our preference has been more for domestic-oriented companies with established distribution and brands because that's where we can see some pricing pressure. The generic space is still very competitive in the US. Europe is anyway tough to crack, and we are seeing significant price erosion continue. So the broad theme is to stick to the domestic-oriented companies.